Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello and welcome to the latest episode of Conversations in Credit, the podcast where we look at the latest trends and developments in the UK consumer credit industry. I'm Alex, a senior associate in the retail finance team, and joining me today is my co-host Jo. And obviously today we're on video, so we thought we'd try something different so that you can see how we interact and do I don't know what a video podcast, a vlog, is that what they're called? I don't know. That's showing that I'm not very techie, but anyway, over to Jo.
Thanks, Alex. This is very different for me. And hi to everyone. So, there's so much we could have picked to discuss today. We could have talked about the FCA consultation on the mortgage rule review. We could have talked about the change to the product sales data reporting for credit brokers. But no, I picked something a bit more interesting. Hopefully that's not too controversial to say. And so today we're going to chat about the FCA's latest discussion paper regulating crypto asset activities. But because this podcast is obviously consumer credit focused, I thought we'd just chat about the bits that were directly relevant to sort of retail lending, retail borrowing, rather than looking at the paper as a whole. So should we dive right in?
So chapter 1 of the paper provides an overview of the FCA's approach to regulating crypto assets. Did you want to give us a brief summary on that section, Jo?
Yeah, absolutely. I think it's fair to say that the approach really, both historically and in this discussion paper, is about delivering and creating a safe, competitive and sustainable crypto sector in the UK. And obviously there's that tension and that balance between innovation with FCA kind of objectives around market integrity and consumer protection. So the discussion paper is sort of looking at the regulation through the lens, making sure that there is, or seeking to make sure that there's this balance between consumer protection, market integrity, effective competition from a UK perspective, but also that secondary international competitiveness objective as well.
Yeah, absolutely. And the FCA also highlights the importance of aligning with international standards and working closely with global regulators. And they emphasise the need for a regulatory framework that supports growth whilst ensuring consumers are protected from the inherent risks of the crypto market.
Yeah, and that's really important, but it is exciting that we are now moving the dial forward again. And so the discussion paper is sort of split into various chapters. Chapter 4 focuses on crypto lending and crypto borrowing. Alex, is it worth summarising what the FCA means by crypto lending and crypto borrowing in this context?
Yeah, of course. And I think the easiest way to describe that is exactly how it is in the discussion paper. So a crypto asset lending is an arrangement where a crypto asset holder, i.e. the crypto asset lender, transfers ownership of their assets to a third party. So that's the crypto asset borrower. That's typically a person, firm or platform. This transfer occurs under a contractual agreement which generally sets out that the lender will receive a yield or a reward or an equivalent value of assets transferred will be returned to them at the end of the lending arrangement. The discussion paper then describes a crypto asset borrower, referring to an arrangement in which a person, firm or platform, i.e. the crypto asset borrower, receives a loan in crypto assets or fiat from a third party firm, platform or person, i.e. the crypto asset lender, with an obligation for the crypto asset borrower to pay back the loan and any associated fees or interest as per the contractual arrangement. In a nutshell.
Thanks, Alex. that was quite a long description, but hopefully the listeners and viewers get the gist. And what's quite interesting is that the FCA makes the point that whilst this market is still really small in the UK at the moment, there have been significant losses which were alluded to within the paper. And I think really this section or this chapter's focused on a discussion around some of the key risks that the FCA derive from these types of activities. And then we can come on to those in a moment, but then also some mitigants, which we can also talk about. So just reading through the discussion paper, kind of pulled out 4 big risks that are mentioned. The first is the loss of ownership. And as you've described, to engage in crypto asset lending or borrowing, effectively, if we're talking about retail customers here, they're required to transfer both legal and beneficial ownership of their crypto assets to the service provider. And the obvious risk here is that, given the volatility of the market, if that provider becomes insolvent, they'll lose their assets and be treated as unsecured creditors. But the assets can also be called upon if the consumer themselves default in certain arrangements. And it's fair to say, I think consumers don't always realise this when they're agreeing to sort of crypto lending or borrowing terms. The other is liquidity management risk, which is effectively, once the consumers handed over their crypto assets and they're in the possession of the trader can do with them as they wish, effectively. So they can reinvest them, they can onward lend them. And so you could have this interconnected arrangement structure, which makes it very difficult, given the nature of the parties that could be involved, to ensure that the chain, if you like, can withstand periods of stress, which ultimately could mean that customers are experience delays in getting these assets back, or in effect just don't get the assets back at all. So that's another risk. And linked to that is the counterparty risk, which is often counterparties in the chains can be unregulated, they might be overseas, they could be decentralized. And because of that, they may have little or no risk management frameworks, which again can increase credit risk and liquidity risk across the chain. And the final one, and I guess the one that is more relevant to kind of overarching consumer duty principles, is the consumer understanding point. Because of the complexity of these arrangements and the risks involved, consumers may not fully understand what they're getting themselves into, and so might not be able to make an informed decision about that. For example, if the lending arrangement is based on a yield generation, that can be speculative because the returns aren't fixed, and the customer may not know how their assets are being used to generate those returns. The value of the assets is also incredibly volatile, which means the value can fluctuate rapidly. And so if the assets have been used as collateral and there's a fixed loan to value ratio, the consumer could find themselves in a situation having to provide additional crypto assets in order to maintain that ratio at the relevant level. And because of all of this, I think what's quite interesting in this discussion paper is that the FCA's current proposal is effectively that crypto lending and crypto borrowing won't be available to retail customers in the current form. So effectively, they're proposing to restrict these activities to retail customers, but they are open to feedback on that. And that is probably an area that I think we should provide, as a sector, as a market, that we should provide feedback on.
Really, really helpful, Jo. And the FCA is concerned about the potential conflict of interest where the platform issues and promotes their own platform tokens, which are often used alongside crypto lending and borrowing. Of course, these tokens can be used to drive that artificial demand and price manipulation. So it's definitely something that they're going to want to tread very carefully with. In relation to the key risks that you just mentioned, the FCA is proposing some risk mitigation measures that could perhaps be introduced to mitigate the risks for retail customers. Could you briefly cover what some of those are?
Yeah, of course. So what was interesting for me reading through this was the fact that the FCA are looking to conch in particular, which obviously we're familiar with in a traditional lending context. And one of the 2 things that they've specifically called out is effectively having creditworthiness assessments. So making sure that proper assessments are conducted of the retail borrowers so that they can meet obligations as and when they arise. But the other point was making sure that you provide appropriate forbearance, which pulls in the Conch 7 type requirements for these sorts of arrangements. So they're things that we're super familiar with. Another mitigant was making sure that effectively customers provide express consent. So I talked earlier about risks to consumers if the collateral loses value and that impacts the loan to value ratio. Often in these structures, lenders, the trader might have a mechanism by which they can auto top up that that collateral. But effectively what the regulator's proposing is that they would have to get express customer consent to be able to do that. Another is making sure that there are real improvements in transparency requirements, particularly around the use of the platform tokens that you just talked about, so that customers are really clear about what they are, how they're used, and the associated risks for those. And the other risk mitigant was, interestingly, effectively where you've got a link to a qualifying stable coin, so you can try and reduce that price volatility within the crypto asset itself. So that was something else that was put forward, because it's perceived that the stable coin will make the lending and borrowing process more stable and more predictable.
Yeah, these measures, they're all aimed and directed to enhance consumer protection and market integrity. But do we think that those measures will be enough to protect consumers?
It's a really good question, and it's difficult, isn't it? Because it's always going to be a delicate balance. And I think the first thing has to be right product for right customer, I think, for me. And so while some of these measures can mitigate some of the risks, there's still going to be inherent volatility, and there's still going to be that complexity. So for certain customers, it could still pose greater risks than for others. And I think that's why it's important that the industry provide feedback, and then it's crucial that the FCA consider that feedback to ensure that if they are looking to open up crypto lending and borrowing to retail customers, that any framework that they put in place to manage that is effective and works in practice. I mean, for me, it's quite an interesting debate, and the timing of the debate is quite interesting, given, we've seen from the Regulatory Initiatives Grid and other publications that HMT are due to publish another consultation on CCA reform. And what we know from previous consultations on that is that the approach is going to be to attempt to repeal all, if not, most of the CCA, and have those conduct of business requirements moved into the FCA handbook. So it is quite an informative time in terms of how the regulator is going to approach risks in lending more generally. I just think it's super exciting times.
Interested when Chapter 5 of this report discusses the potential restrictions on using credit to purchase crypto assets. What exactly are the FCA's concerns here?
I think it comes back to the just general concern around the unsustainability of debt, given the volatility that we just mentioned, and the risks to customers. I think they're worried about impulsive purchases, potential for over-indebtedness. And so one of the points in the discussion paper, and one of the things that they're wanting to explore, is whether they should restrict the use of certain credit products, like credit cards and other credit facilities, for customers to be able to purchase crypto assets in the first place.
Yeah, and I think that's a really crucial point. And we expect that the FCA's initial expectation is that the qualifying stable coins issued by authorised stablecoin issuers would be exempt from those restrictions. But like you said earlier, Jo, they're seeking feedback on the implications and feasibility of the potential restrictions. So for listeners or viewers alike, then there's your opportunity to feed in.
Yeah, 100%. And the discussion's open, I think, for responses until the 13th of June. So there's still plenty of time to feedback. Well, that wraps up our discussion for today, Alex.
Thank you very much, Jo. That was really insightful, and hope that our listeners and viewers enjoyed it. If you have any feedback on us being on video, then please do get in touch.
But be kind.
Thanks ever so much, Jo.
Cheers.
Thank you for listening to the Evershed Sutherland Legal Insights podcast.